we go, boys.
All right. Gentlemen, are we ready?
Yes, sir.
You're ready.
I'm going to give you guys fair warning. I have like 7 teenagers in my house. Everybody's using my internet because my son thought it would be a great idea to throw a pool party for spring break. And so if I lag or I cut off, you guys just pick up with whatever obscene comment or gesture I was about to make.
Well, I don't make any obscene comments, so it'd be hard for me to do that.
In public. You don't make any obscene comments in public.
Well, that's true. And we're technically in public, I believe.
That's true, but the people that watch is their family, so technically they're your family and my family, and so they would definitely appreciate some genuine Dwight, which has some pretty terrible jokes, some which are just probably borderline racist, which is all good, man. I mean, at the end of the day, you know, we're all here to have fun and to learn, right?
Don't be telling all my secrets now.
I'm the friend that your wife tells you, why do you hang out with that guy? Like, why? That just doesn't make any sense. Well, or William's dad is like, that's the financial advisor. Like, I don't know if we're making the right affiliations here, William.
Yeah, that's definitely been questioned. Yeah, that's the guy you're working with. Sure, he's better at what he does than the way he talks and looks sometimes. But yeah, good to be with you guys again this week.
Very, very good to be with you guys this week. So what we're going to talk about today, which is a very, very unique and I think important financial concept to understand, is why wealthy people borrow money. And what I would like for you guys to know, anyone that's watching us, regardless of your income level, is I will tell you, as the in-house financial advisor for our firm, anytime that any client wants to set up any type of financial instrument, doesn't matter what it is, the first question that they ask is not, what returns am I going to make off of this? The first question that they ask is, how can I access the money? Can I take a loan against this? Now, for a lot of people that maybe don't have some massive tax problems yet, because ultimately the goal here is to teach you how to make money and how to have bigger tax problems. For people that don't have some massive tax problems, you don't understand how vital it is for wealthy people to access money without having to pay taxes. It is a big freaking deal for them, because generally speaking, anytime that they move money around or anytime that they sell something, they're going to get taxed. Because once you reach a certain level of income, like it almost seems like you can't even open a bank account without getting taxed. So for them, having the ability to borrow, because anytime you take a loan, you're borrowing, and that's not a taxable event. Having the ability to borrow against something is extremely important, and one of the very, very first things that they look at whenever they're going to be investing money in something. So that's how I'd like to start this conversation. You guys add in your 2 cents here.
Well, I think what I was preparing for the conversation tonight. One thing that stuck out to me was wealthy people. They always have their money invested, earning money, making their money work for them. So for them to take that money out, they would have to generate a greater return than what they're currently getting. So a lot of times it's just easier to keep that money where it is and then use that as collateral and take a loan from it and then go do your investment that you're wanting to do. And so, you're going to have to repay, the loan, but this other bucket of money is still, sitting there, with a return, so they're just basically using money to make more money with. And, once you get to that point, it's not a matter of if you can do this investment. It's just, how am I going to do it? Does that make sense?
Yeah, because another thing that we may not have talked about too much is that the only time that new money is really created is when debt is created. So if I earn money and then I pay you for a service, we're just swapping out the same money. But when I borrow money, I still have all my money, and now I have additional money. And so that's the way that the world operates. And borrowing money is the way that the economy ultimately functions. And so for middle class America, I think the fear of debt and what they've been brought up on and taught, it's not that the debt is inherently bad. It's that they are concerned that they won't have the money to repay the debt. Whereas the wealthy will borrow money to purchase assets that produce additional income. So paying the debt is no longer a concern. It's now I can create additional streams of income. And so when the banks, even in a high interest rate that we're in right now at 8 to 9%, if they have an investment that can return even a greater percentage of that, then it makes sense to borrow the money. And if that interest rate goes lower, then it makes even more sense. And the other side of it is that people don't think about is in high income earners at the highest level, they're paying 35 to 37% just on the federal taxes. And so they need to keep their cash for tax favored investments. And so they borrow the money at a lower rate. Like I said, even at 8% is a lot cheaper than 35 to 37%. So it just makes sense to go borrow that money. And I'll see that sometimes is that when clients would come to us that maybe don't understand this concept, they will have taken money out of an investment like a 401k or retirement plan, and they'll come in and say, well, I paid my house off. Now I don't have a mortgage. Well, you also don't have any retirement savings anymore. And now you have a big tax bill on top of that. So having a mortgage is not inherently bad. And it's a way to actually build more wealth. Gives you a little bit more security because there's a concept that if I owe the bank a lot of money and things go really bad, the bank's going to work with me because they really don't want to take these assets back, especially in a bad economy. So it's really not as risky as a lot of people were led to believe, but it's how a lot of people were brought up that debt is scary, avoid debt at all costs. But being debt free may feel better in some sense, but I don't know a debt free person that's really built true wealth. And I'm sure there are. We always get comments from people, but for people that we've seen build massive wealth, they've borrowed money to get to that point. And even still, someone that has a lot of income, if they've got a mortgage rate at 2, 3, 4, or 5%, so let's say they're not going to pay that mortgage off. It doesn't make sense because now basically once you get into an inflation period, that mortgage is really not even costing you much because the inflation rate is higher than your mortgage interest rate.
Well, what I want to add to that too is, I started in the life insurance space, and one of the first things that I would talk to clients about is like cash value build up life insurance policies. And the reason that I would talk about that and I would suggest that as a great starting point for their financial wealth building is because they can borrow against those policies. And I would get a lot of pushback because obviously when I started as a financial advisor, I started with middle America. I mean, literally, if you were alive and had a job, you were somebody that I wanted to talk to, because when you start a business, I mean, you get what you can get, right? And so I would try to get people to understand this concept of borrowing money. And when you're talking to middle America, it's very difficult for them to understand the borrowing money concept because they're like, why it's my money? Why do I want to borrow against my money? But when you look at what the wealthy do, and that's why the wealthy, I think, really love real estate, because real estate is probably the most popular asset class that you can borrow against. Assuming that you have a property that's worth $200,000, and every year, let's say that property is appreciating by, I don't know, let's say 3%, but you can take a loan against that property and go and invest in another property, or go and invest in stocks, or go and invest in something else. That property still has a $200,000 value, and that property is still appreciating at a rate of 3%, or like in the last 3 years at a rate of like 75%, because that's just what real estate has done in the last 3 years. So that's where you're able to start leveraging different things that you own to go and own more things that will make you more money. And I have a gentleman watching, and he's a really good friend of mine. We were teachers together, and we were having this conversation earlier this week because he bought his home at the right time. He bought his home in 2017, right around that time frame, if memory serves me right. And so now he's built a lot of equity in the home because the prices of homes have gone up astronomically. So I told him, in the future, something that would be wise for you to do is refinance your home, pull out equity, use that equity to go and buy a second rental property, or to go do some real estate flips or stuff like that. And then I think the biggest problem that people make is they'll take that equity, like they'll see that their home has appreciated in value, and now they can pull $50,000, and they do that. They refinance their home, and they take that money and dump it back into the same home that makes them no income, that doesn't increase their net worth at all, but they wanted a patio and they wanted a pool. And to me, and that's why Dave Ramsey is so popular, because Dave Ramsey understands that people are just really good at just not making the best financial decisions. So he just has he basically has the same advice for everyone. No debt ever. And realistically, for most people, that's probably the advice that they should follow. But if you're really wanting to figure out how wealthy people get wealthier, if you want to figure out how our clients continue to get wealthier, and kind of circling back to the life insurance concept, clients come in throwing $100,000 a year into their life insurance policies. It's a hell of a lot of money, but they understand that they can borrow against that without paying any taxes. So I don't know. You guys give me some feedback on that.
Yeah. Earlier today, I was talking with a client of mine and explaining, how the itemization worked, and their itemized deductions weren't enough to exceed the standard deduction. But she has a business and she has a home office. So through the home office, she's going to be able to deduct some of those home expenses, the mortgage interest and things like that. And so on the mortgage interest statement, I was just blown away that they owed such a low amount on this house that they bought just in 2016. I mean, it was like $87,000 that they owed that was still remaining on the principal. So the mortgage interest was only like $700 that they had paid all of last year. And I was like, so I mentioned that to her. I was like, man, y'all don't owe hardly anything on this house. And, based on where they live, it's got to be at least a $500,000 house. And she said, yeah, a few years ago, we were just tired of having a house payment, and we started just dumping any extra money that we had towards the mortgage, towards the principal. And then it dawned on us that we have a 3% rate, and that we can make a lot better with that extra money that we were paying towards our mortgage in the stock market. Her husband's a big stock market stock trader, and he follows the market really well. And, she's like, he usually gets 12 to 15% return on his investments. So the problem, though, is being disciplined enough to take that extra money to put towards those investments. And see, unfortunately, a lot of times people say that they're going to do that with that extra money, but they don't. They just spend it on a liability and not have anything to show for it. So that's a smart way, and they realized what they were doing. So that was just an example I thought I would like to share. Just happened today, so it's fresh on my mind. But you've got to be disciplined, to be able to move that extra money and invest it, and not just go buy a vehicle with it or something that's going to depreciate. You've got to be smart with that money. And I told her, I was like, the problem, because they're both disciplined people. And I said, the problem is most people aren't, and they would just waste that money.
Yeah. So that's why people will lock that money into a mortgage. And the thing is one of the problems we see, like with middle America, is that a lot of the money, they use their 401k as their quote savings account. And then when they run into an emergency, they have to pull the money out of the 401k, or they pay money extra on this mortgage. And then if you have a problem, then what? You either got to refinance, you got to have good credit. We've had clients that unfortunately just don't have good credit. They make a lot of money, and then when they run into a situation, they can't refinance. And so then what? And so it's a hard concept, but it does come to discipline yourself. But instead of throwing chunks of money at the mortgage each month to, quote, pay it down, because until that mortgage is paid off, you're going to have the mortgage payment. You're always going to have taxes and insurance and things like that. So you're never really debt free on a home, but it's just a concept that people believe helps them sleep better at night. But ultimately, if you took that money and put it in an investment or even a high yield savings account, you could potentially have many months of mortgage payments saved up that if everything went bad in your life, you still had money to pay the mortgage. But if you prepay that mortgage using your cash and then you lose your job or things like that, then you're in a bad situation. And the more equity you produce in there, then the more likely you are to be foreclosed on. And we've seen cases like that where clients who had money and gone through recessions and jobs and things like that, that if they would have set that money aside, they actually would have been safer than putting a chunk of money into the mortgage. But it's just that feeling of, well, I've got to be debt free. And sometimes you can't convince people that they believe that that's the way to be. And if it, ultimately it helps them sleep well at night. But when we're talking about building true wealth, which is what this podcast is about, we see some of the pitfalls there. And you got to change the way you look at debt. And debt is a tool to build wealth. And so if someone's going to loan you several $100,000 to buy your home and buy rental investments and things like that, man, you're better off because you can leverage the little bit of money that you have with their money. And now you've got an opportunity because the return on investment isn't just the down payment you put on there. The return on investment then becomes the whole purchase price of the home. So you can control a lot of real estate using other people's money, and then take care and have discipline. You'll build wealth, and the debt will eventually get paid off. But that really shouldn't be the goal. The goal should be wealth creation.
It's funny that you say that, William, because I've had this conversation with a lot of people that are just so fixated on paying off their mortgage. And one of the things that you need to understand about banks is, like, to your point, you could give so many extra payments to your principal on your mortgage, but miss 3 payments and it doesn't matter what you've given. The bank's going to tell you to pack your stuff and get the hell out of your house, regardless of what you've given in the past, because there's still a balance outstanding on that house. Like to me, if they offered 60-year mortgages, I would take that in a heartbeat. I mean, like, that's perfectly fine. I don't give a damn about paying off this house. I'm just going to make sure that I have enough life insurance, and when I die, the life insurance is going to pay everything off. I would jump on that all day, every day. I've even contemplated like 40-year mortgages, because now that just gives me the ability to stick a renter in there, have the renter pay back the bank, and that renter is building my net worth with every single monthly payment. I'm not paying the bank. The renter is paying the bank. But and to your point, it's kind of funny too, because like that whole credit situation, people think that bad credit is exclusive to people that don't make a lot of income. But you remember, and I'm not going to share any details, but remember that one case that we were working on where the gentleman was wealthy, like literally probably $15 million of real estate is what he had. His credit was so bad that, like, he was rich, but he was broke, because we couldn't refinance anything to pull out equity. We owed taxes, we owed property, we owed so much. When I say we, I mean him. And we were stuck because there was nothing that we could do because his credit sucked. So the reason I share this with you guys and with the viewers is because I want you to understand that a lot of the mistakes that you guys make, wealthy people make those same mistakes too. A lot of the times that's the biggest reason why they come to us, because they've just made a lot of mistakes, and understanding that sometimes you're able to make a business work and monetize at a very high level. That doesn't necessarily mean that you understand money or how money works.
Well, I was listening to, there's a guy I follow on Instagram, and he does a lot of interviews with people that are millionaires. And he basically asked them, how they got started, how they accumulated their wealth. And last night, one came across the feed, and the guy was a 100 millionaire, very, very well off. And so the guy asked him, if you were down to your last million, what would you do? And he said, I would go borrow 5 million and start right back over. So you can use that 1 million to basically borrow 5 million, and then he can deploy that, into other investments that are going to generate him the money right back. And he's just going to rinse and repeat. So that was a perfect response. Roll has disappeared.
Yeah, so that goes down to understanding how to leverage that money. Instead of spending it, we're gonna leverage that money. And when it comes to real estate, you could borrow, on a piece of property, you put 20% up, the bank gives you 80%. So you're able to borrow 4 times the amount of money that you actually put into the project. And where else can you do that? And if you walk into the bank and try to borrow money for anything else, you can't borrow money for stocks and things like that. You can get some margins and maybe some things like that, but actually walking into a bank and trying to get hundreds of thousands of dollars. So there's a reason why they loan so much money on real estate. They consider it to be a pretty safe investment overall. And they know that if for some reason they have to take it back, they'll be able to get their money back. So that right there tells you that the debt on real estate is not as risky as some would make it out to be. The biggest thing is to understand what you're doing, get some education, learn how to leverage the money, because if you leverage it incorrectly, it can wipe you out. But the clients that we work with, they have learned this skill very well. And it's a way for first generation millionaires to build wealth, is to use the other income, other people's money to go along with their income. And all of a sudden it allows them to produce additional income from the investments. And it makes you a lot safer. Like you're talking about with the guy that had $1 million, and he said he would just go borrow $5 million. Well, now he's got a lot more money and he's a little bit more secure. So being able to borrow money is key to maintaining wealth, and also just that gives you some more liquidity as well along the way.
So let me ask you guys a question then, because Dave Ramsey, in his own right, and we'll probably do an entire podcast on Dave Ramsey, and we'll title it "Why We Think Dave Ramsey is Full of Shit," and hopefully we don't get sued, because he definitely has a hell of a lot more money than we do. So maybe that's not a good idea. But Dave Ramsey preaches that all debt is bad debt. He even encourages people to cash out their retirement accounts to pay off debt. I have my opinion on that, but then, I mean, basing it on what we're talking about today, why do you think that he suggests that type of advice? I mean, because he's not a dumb guy. He's a very smart guy, very, very smart guy. But does he just assume that people are just going to make bad decisions?
Well, I think okay.
I think part of the problem is he's talking maybe to a different type of person than maybe the people that are our viewers. I think the initial stage where Dave Ramsey is helping people get out of bad debt, the debt that he's trying to help people get out of predominantly is, credit card debt, student loan debt, things like that really chain people to being able to start, deploying that money towards wealth building activities. Now, after you're out of that kind of debt, at that point, you need to be looking at good debt, which is what we're talking about. Using leverage to buy investments, having tenants in place. They're going to pay those mortgages off, pay the loans off. So, from that angle, we're helping people hopefully at different stages. Maybe they've already been through that, that part, and they're looking to build wealth. But then too, maybe they're scared because they don't want to rack up that debt again. The problem with the debt they had before was when you go buy something and put on the credit card, and then sit there and pay $36 a month on it, and it's a $5,000 bill, you don't have somebody else paying that for you like you would with an investment property or stocks or whatever the investment happens to be. So hopefully that sheds light on it. That's my thought anyway.
Well, I mean, we got to give Dave credit. I mean, he has a wonderful, tremendous business, and he has built it over the years, and he has a great following. And he definitely knows who his ideal customers and things like that. So his business model works, and it's built him a lot of great wealth. And I think back in his early days, he was flipping a lot of houses, and the bank got a little nervous that he was flipping so many houses, and they pulled his line of credit, which has now led to that experience for him. So there's an underlying reason as to why he says what he says on that. But to Dave's credit, based on the money he's making, it's easy for him to say, I'm not going to take on any debt because he's got so much cash flow coming in now that it really doesn't matter necessarily. But yeah, there's a point that what we're talking about, bad debt versus good debt, and he would lead you to believe that there's no good debt and all that. But clearly, debt that has no return, that has a super high interest rate, then yeah, you need to get rid of that debt. That debt's not doing anything to build you wealth, and it's taking your monthly cash flow. But the debt that can produce income or gives you an opportunity to buy something that can increase in value, like you were talking about, Raul, the gentleman that you work with, that bought a house, 6 years ago, 7 years ago, has seen that investment return. Had he not borrowed the money, he may not have that asset today. And so that's a very the key part of it. So another thing too is if you sit around and try to pay off your mortgage and you don't save for retirement and do other investments, what you're going to end up with is a paid for home that doesn't produce income. So if you're living in that home, you don't have the income to go with it. It's not really going to help you that much. But if you invest along the way and just make your monthly mortgage payments, then you will get to a point where, you'll have a paid for home, let's say in retirement, plus you'll have, $1 million or $2 million saved up from your retirement investment. And that's going to make you a lot more secure, than rushing out to pay off the debt just because you're scared that you won't be. So a lot of times it's irrational thoughts and fears that we see people, because they'll sit around and think, well, what if all this bad stuff happens? And most of the time it doesn't. And then I see people doing the opposite, that they'll sit on a lot of money as well because they've got to feel secure. But that money needs to be invested to produce returns. So just because you have money sitting in a savings account, that doesn't mean that money, even though it's the same money on the same amount of money on your statement each month, inflation's eating up that money. So you've got to still have some investments out there to produce wealth and everything. But yeah, Dave's a great guy. He's been at my church before and stuff like that, but he certainly got his following and believes his mission. So as a business owner, you got to believe in your product, and Dave definitely believes in what he's selling and has done very well with it. And another thing, and I know this isn't about Dave, we'll talk about him, but he has created a wonderful succession plan in his business that will allow him ultimately to retire and still earn income. And that should be the goal of any business owner out there. So we'll give that to Dave, but if you want to be wealthy, you're going to have to borrow some money along the way.
Needless to say, ladies and gentlemen, this will be the last podcast that William's going to be joining with us because he just officially got fired. But we'll have somebody else that will be filling in for him. Actually, I'm glad that you brought up the succession planning, because I don't watch Dave very often because a lot of the times he just really makes me upset. But I did watch the succession planning one, and yeah, he actually does have he's, like I said, he's a very smart guy. But I will tell you this though, and something that you also have to be mindful of. Dave grew up in a completely different era that we grew up in, and he's an older guy, and back then, I think it was a lot easier to become wealthy with cash components than it is today. Right now, guys, if you want to build your way to wealth 100% with cash, you will die and you will never be wealthy. There's just no way. Things are just so astronomically expensive. wages have not kept up with inflation, it is incredibly difficult to acquire high quality assets unless you are willing to leverage. But like everything else, any decision that you make has to be well calculated, and you always have to have cash. Well, like one of the things that I tell clients all the time is, in spite of what you might hear other financial advisors tell you, I always want you to have a substantial amount of cash. I will always make that recommendation. And a lot of the times the advice that they'll get is, oh, you have 100,000, 150,000. We just need to take all this and throw it into the market because the market just trends up with time. Well, it trends up with time only when it doesn't. And what happens if you need the money and we're in a market correction or in a recession, and now you have to sell at the bottom of the market? So things like that, you have to take into consideration, and you always have to make well-calculated moves, and you always have to have cash. That's my personal opinion.
Yeah, that reminds me. I guess it's been a while, probably 20 years ago, and I called my financial advisor at the time, and the market was down. I mean, down.
It wasn't me. It wasn't me, by the way.
No. And he's like, "Are you calling to complain at me or complain to me?" And I was like, "No, why?" He's like, "Every call is just complaints today. People wanting to sell and fussing that I put them in these investments." And I was like, "No, I'm actually calling to give you more money. Now's the time to be buying." And I understood that you want to buy when it's on sale, right? And a lot of times people freak out when they see their account balance drop or go down. But that's the time you just need to start putting more money into it. So you do need the cash on hand. How much is Warren Buffett sitting on right now? 150 million or billion, or just sitting on cash?
It's with a B. Yeah, it's billions.
Yeah, I thought it was billion. 150 billion. Just waiting for the right opportunity. So yeah, you've got to keep some cash on hand.
Yep.
Which I guess good, because ultimately that cash, you can send it out and make babies with it, right? Make little money babies with your cash.
It's not that kind of show, Dwight.
See, I use the analogy that they're your soldiers. Y'all remember when we were kids, we had the little green soldiers that we would play with and stuff, and you would want to keep as many of those alive, and that's your money there. We don't want to have our soldiers die on us. So Dwight's trying to make babies, but I'm trying to fight with my army.
I'm replenishing.
Yeah.
The only thing people are going to remember from this podcast was that Dwight said, "Take your money and go make some babies." That's the only message that's going to stick today.
Yeah,
but not real babies, because they'll just cost you money.
I know. They are definitely a credit. Sure. Yeah, you'll be okay.
I call that the child tax. Anytime we go out to dinner or anything, and then you order them a plate of food that they don't eat for the 100th time, and you say you're not going to do that again, but you still do. Those are what we refer to as the child tax, because you spent some money on something that you would not have spent money on just because you have children. But we all love our children, but yeah, they do cost us a little bit of money from time to time.
Quite a bit of money from time to time. Yeah.
And more than the $2,000 credit, right?
Yeah, I'm still trying to figure out how they think that is adequate, because that doesn't. And then what's interesting, of course, we go off topic a little bit here, but they give you that child tax credit until the time that they're 17. So apparently once they become a junior and senior in high school, you don't need the credit anymore for those 2 years, when they're actually doing kind of really expensive stuff during those 2 years.
Yeah.
So trying to explain that to a client, I try to tell them, next year, your kid's going to be 17. They're like, so what? So what? You're going to see that $2,000 per child come off of once they hit that 17 years old. And they're always like, well, I don't really understand. I'm still spending money on them. You're right. You will always spend money on them. But for these 2 years, there's no credit really.
Yeah. Sometimes you spend money all the way till they're 30.
Right. Those are the boomerang kids that, you send them out and they return home to you. So you definitely want to teach some of these skills, and money matters to your kids, so maybe they won't be a boomerang kid in their 30s.
I remember my son, because we always have that conflict over the holidays, like what house are we going to and stuff, and he told me, he was like, "Don't worry about it, Dad." Said, when I'm old, I'm always going to come to your house. And I was like, dude, when you're old, I'm going to be very wealthy. I'm not even going to be here. I'm probably going to be in Europe somewhere. So you don't necessarily have to worry about me. You do your own thing, son. We're going to be just fine. But it's one of those things where you definitely want to make sure, well, first of all, on a personal level, you want to make sure that you hit some financial goals, because I definitely don't want people to be in a situation where you have to rely on your kids to take care of you when you're older. And in the Hispanic culture, that's the norm, right? And I don't, there's nothing wrong with that, but if you don't want to put that burden on your children, then you definitely, and especially if you're a working professional. Like, my parents migrated from Mexico. Like, they came here with nothing, and they did as much as they could with what little they had. And they're basically, they're the backbone of everything that I've done in my life. I don't have a problem at all doing whatever I need to do to take care of my mama. I don't have a problem with that at all. But I'm a working professional. Like, I went to school. I have my profession. And so there's absolutely no reason why I can't establish myself in a way to where my son doesn't have to worry about me, and my son shouldn't even have to worry about himself, because at that point I've created my trust, and I make sure that, to your point, William, there's a succession plan. So he gets money when he's ready to receive money, not when he's living the stupidest years of his life. And all of that has to be factored into the mix.
Well, maybe we could do a whole episode on something like that, because, the reverse of that is when your children are still expecting you to support them, and they're in their 40s and 50s, and you're in that retirement age. It's hard, because you're trying to enjoy your retirement, and then you're also having to support kids that can't support themselves. And I've got a friend of mine who their son, who's like 50, lives next door in the house that they own. His dad goes over and cuts the grass. The son pays no expenses, not even the insurance on the property, none of the property taxes. And, the parents are sitting there retired with a good retirement income, but still, a good bit of their retirement money is still supporting their kid. Well, their adult child. It's just ridiculous to me. We need to prepare our children to be self-sufficient. And I remember when I told my dad I was going to ask my girlfriend at the time, who's now my wife, that I was going to ask her to marry me. And he said, if you're old enough and mature enough to get married, then you don't ask me for anything else, because you need to be able to support your family. And he's like, now, in the case of emergency, I'm here for you. But if you're going to take that step, you need to be man enough to take care of your house. And if you have kids along the way, you need to support them. And I've never asked my parents for anything like that, ever. So I'm not a burden to them, but
now you're just a burden to us.
Yeah. I don't ask you for money.
No, but I have to listen to your jokes. So,
well, maybe we'll clean some up and I'll share some on a podcast one time.
Yeah, please don't.
Did you ever get the toupee clip to send to his dad so he could enjoy it as much as we did about washing it out and everything?
No.
Yeah, maybe we can edit that out and send it to him. Yeah, he'd get a kick out of that.
We should. We need to have William's dad on this show.
That'd be awesome.
That would be very interesting. It is just going to be an hour of why he thinks his son just makes the stupidest decisions, and I'm going to love every minute of it. It's going to be great.
Yeah,
I wonder if William's dad has his camera under the desk too.
I'm just going to let y'all have that. That's not truly what happened, but it's the way it looks, so we'll go with that. But now Dad's decided, during the middle of tax season that it would be a good time to take a cruise. So I hope he's enjoying himself this week. He's down in the Caribbean and South America. Posted some pictures from Jamaica yesterday. So I think he's enjoying himself. But Dad, when you see this clip, we've got plenty of work here at the office when you decide to get back from your tax season vacation.
He should know better by now.
Tell him the story of your birthday card. This gentleman, by the way, which I'm very eager to meet because I've never met him face to face. Man, he's just straight up OG, man. He's just, they don't make him like that anymore. I'm very excited to meet Mr. Bennett because we're gonna have some good conversations. But tell him about the birthday card.
Yeah, so as Raul has pointed out before, my dad was an accountant for many years. I grew up around the tax business. Raul takes it even further back, says that my granddad at the time was the CPA for Abraham Lincoln. So we've been doing accounting in this family for a long time, over multiple centuries, if you listen to Raul. But so anyway, so Dad decided to retire from his industry job about 2 years ago, and he said at that point he would come work for me and things like that. And so he took about a year off, and then he was ready to come to work. So last year we kind of eased him in a little bit. He worked kind of part-time, and then this year he's been on it. I mean, he's excited about tax season, and he started doing some management around the office. But anyway, when it came time for my birthday, they all put a birthday banner around the office, and I showed up for work that day, and I have a birthday card, and everybody has signed it, their names, including Dad. So he signed it, David Bennett, happy birthday, as if he was just an employee of the firm and not my dad. So it's very interesting because when we work together, we're all about business, and then we have fun, outside of work, but we also have fun, during the work. But yeah, he's old school on some of those things, but he's brought a lot of good things to the firm, and we're glad to have him around here. But yeah, that was funny on my birthday when I opened up the card and just signed David Bennett.
What was his? How come he didn't sign it, Dad?
I don't know.
Does it make sense?
What's that? Yeah, because everybody around the firm is like scared to call him David. They call him your dad. I talked to your dad today, and I'm like, he does have a name. His name is David. So I guess he was just wanting to fill in. But I mean, I opened that up, and it was like, oh, all the employees, including my dad, has signed it their name.
That's an old school that's an old school dad for you, man. You got to
put a gift card in it.
No, there was no money. Apparently, only the grandkids. The grandkids get money in their card, but we just get a card. And did get the old Facebook post this year where he put out there "Happy Birthday" to my son. So that was pretty good too. But yeah, I'll be glad when he's back from cruising, because like I said, we're going to be here for the home stretch of tax season.
That's awesome, man. Well, you at least I raised we're kind of getting off topic here, but it's interesting. It's to keep people engaged. But I raise my son the same way that my dad raised me, which is with just some old school disciplining and a lot of very, very aggressive sarcasm. And it seems like your dad's the same way. So I don't think there's anything wrong with that. Gotta toughen up these boys a little bit.
Yeah, he does want people to work and all of that. So yeah, it's been good though. It gives me a little bit of discipline around the office and has helped with some of the management stuff. So again, we're very thankful for it, and glad he's able to enjoy some time off, because he does remind me, I did retire, so I am going to take some time off. So I appreciate that. Him and Mom are having a good time this week on a cruise while we're sitting here doing some tax returns.
It's been a week.
Yeah, and so our viewers know Friday is the deadline for your S Corp and partnership returns. So just a couple more days left. They'll be filed or extended, whichever.
Yeah, at this point, if they're still scrambling at this point, I would just go ahead. You've lost the battle. Go ahead and extend it. But you know what's interesting about these tax returns, though, is they only give you 2.5 months to try to get your year closed out. But if you extend it, you get another 6 months. So, I mean, it's just very interesting how we have that original deadline, but then we have a 6-month extension window to really get stuff together. So yeah, don't rush it if you're struggling to get it done. Just put it on extension and then work on it. But try not to procrastinate. But it does give you a little bit of breathing room.
And
So
realistically,
what happens? Go ahead, Dwight.
I was just going to say,
what happens?
Realistically, I think I'm on the delay.
So am I. Go ahead.
So even if you do extend it, I mean, in my opinion, because the partnerships and S corps just flow through to your personal anyway. So if you are going to owe, then I try to get them done by at least April 15th and go ahead and send in the money there. That way you're not accruing any interest or anything past April 15th. So basically that extension can buy you at least another month, and get everything wrapped up. But if not, just file the extension, and that definitely gives you 6 more months on the business return. Go ahead, Raul. Sorry.
No, you're fine. The only thing that I was going to say is so what happens if you don't file an extension for your business or LLC partnership by Friday? Then that means that you get assessed a penalty even if you file by April 15th.
Yeah, if you don't file an extension.
Okay.
It's a monthly penalty, William?
It's a monthly penalty, and the penalty applies to every partner in the partnership or the S corp. So if you've got a lot of partners in your partnership, those penalties can add up quickly. But if you happen to get a penalty, then we help people get out of them, but we do try to avoid them at all costs. But a lot of people that have just started new businesses, or their neighbor told them to get an S corp or set up that LLC with the multi-member, they don't necessarily realize they've got to have an extension if they don't have it by March 15th. They're thinking, I've got to have my taxes filed by April 15th. And so then they'll get that letter in the mail. And like I said, it's per partner on there, and it's increased a little bit. I think it's over $200 a month at this point for being late on it.
So does that mean that, like, if you and your wife are both partners in the same LLC, it's $400?
Correct.
Whoa, that's a lot of money.
Yeah, and that's just for 1 month. I mean, if you drag it out 6 months without the extension, thinking that you had one, it can be several $1,000s.
Yeah, I can see where that would be a problem. Which reminds me, I'll send you my extensions tonight, William.
Okay, good.
Yeah, because William had nothing else to do tonight.
I don't care if he did or he didn't. I know where he lives.
Well, the good thing about filing extensions for a partnership, you don't have to have all the K-1s. You just have to get the extension form in. So it is a little easier to file the extensions. That's why I was saying, if you're scrambling, just go ahead and put your extension in, and then get the rest of the details put together. We'll take a lot of stress off of you. So yeah, send them on, and we'll get them taken care of for you.
Beautiful. Which kind of reminds me, guys, and let me do this now. If there's like specific like financial or tax stuff that you guys want us to talk about, let us know. Let me see here. Oh, here it is. You know what? We never we created an email exclusively for this podcast, and it got canceled in cancel culture, I guess. And we just never created it again. So we definitely need to do that. But in the meantime, if there's something that you guys would like for us to discuss, or you have any questions, feel free to send us an email. We'll do the best that we can to either cover it here or just get you, just a little bit of free advice to kind of guide you in the right direction. All right, gentlemen, yeah. What else do we have to talk about? I think we're hitting up on the hour here. And so we kind of digressed there a little bit on the borrowing money, but I would say the only thing that I want you guys to understand is the leverage component. When I'm talking about leverage, is saying that you have one thing and you're using that one thing to go and do something else. Like when you say, I want to leverage my time, basically what you're saying is you're going to hire someone to do what you're doing right now so that you can use that time to go do something else. That's why, people that reach a certain level of success, they'll hire an assistant, or they'll hire a secretary, because they're able to leverage that secretary for all the little minute stuff that they don't want to do so that they can get that time back to go do something else. You can do the same thing with investments and with assets. That's why it's very important for wealthy people to have assets, investments that they can leverage, that they can borrow money against, so that they can go and acquire another asset. So now they're making money here and they're making money here, and they're just continuing to grow their net worth. So any final remarks there, gentlemen?
Well, yeah, with leverage, I mean, it can be very powerful. And, like personally, just to give you an example, I had a friend of mine who I've done some hard money loans with before. And he was offering to pay 20% interest. Well, I didn't quite have all the money that he was needing to borrow, but I do have a HELOC. And through the HELOC, over the past year or so, the rate has increased. And, currently it's about 8%. Well, I took the money out of the HELOC to let him borrow it, and I'm still 12% to the good. And so that's just a perfect example of what we can do with money. And, to be honest, most hard money loans right now are at 12%. So I'm still making 12% what I would normally do anyway. So, and then two, with that money, it's going to repay my HELOC. Plus I have a balance for some home improvements like you were talking about. That's not good to do, but I do have a balance. And so I'm going to use that money, the interest and stuff that he's paying me, to chip away at that balance and to get rid of it. So then I do have more available to deploy for actual investing that'll generate a good return. So I think you just got to be smart with your leverage. Just like with any investment, the first rule of investing is never lose money, and rule number 2, refer to rule number 1. So keep that in mind. And it's definitely a great way to make money babies, right?
Then we can turn them into soldiers and fight our battles and create more wealth. But what Dwight didn't tell you, Raul, he told me this story the other day. He said, I was feeling pretty good about getting 20% return on my money until he realized the guy that he gave the money to made like over 100% return on the money.
Oh, yeah.
And so that's the thing. But that guy knew that even paying Dwight 20%, that sounded outrageous, was enough for him to take that money and make even more money with it. So that guy clearly understood the power of leverage. But that was a good story we talked about the other day. Like Dwight said, man, I made really good money off of that deal. But then I found out the guy comes by, he's like, this is what I made with your money. And Dwight's like, oh man. So it was a good lesson there. But yeah.
But he and I had a conversation about how I can get in with him on a partnership level.
Okay.
So I can make the return that he made in the future.
Yeah. So then we'll be helping Dwight figure out what to do with all the money that he's going to make off his investments. And that's one thing I don't think we've talked a lot about, is that when it comes to real estate and things, that's Dwight's wheelhouse. And he really helps us and clients understand, what goes on in that area as well. So we're always talking about deals and things like that can come up. But yeah, guys, this has been another great night. I want to give another shout out again to our hometown here, Warner Robins, Georgia. And the thing that I found out after last week is that so many people have lived in Warner Robins because of our military base and everything here, that they may not have lived here, but a lot of people have come through this town. A lot of people continue to come to Warner Robins. And so, that's where we hail from and are very busy locally, but we've also taken on clients regionally and nationally by working with you guys as well. So it's been a great thing. So they call us the international city, and now we're working with people all over the country and everything. So it's been a real blessing, and I've enjoyed our time here. Hard to believe we've completed our first month here together. It seems like we were just talking about getting this thing going, and now we have a month, and we've got a few viewers watching it, and then people watch the clips during the week, and it's been great doing this with you guys.
Likewise, gentlemen. Well, I'm over here in the Rio Grande Valley, so nothing having to do with Georgia or Tennessee, but definitely appreciate the people here from the Valley. And, whatever we can do to help you, at the end of the day, we just want to give you some nuggets of information, some free information. So the only thing that we ask is just make sure that you like this stream, share it if you find the information valuable. We're streaming it on YouTube as well, and hopefully we'll bring you some more good content that can help you along the way.
Awesome.
All right. Well, ladies and gentlemen, thank you for joining us today, and we will see you guys next week.
Cheers.
Cheers, gentlemen.
Yeah.